Hi, clients of Future Gen Solutions. Today, I'd like to introduce Adrian Rowley out of Watershed, based in Collins Street, Melbourne. This is a manager that we have been using over the last 12 months and taken to greatly. And the reason for that is because these people exhibit the independently minded qualities which organisations like ourselves collaborate with and move towards. We think it's a particularly good time for ourselves and organisations like Watershed to move forward with opportunities. So I would like to introduce Adrian today, who's lead portfolio manager, shareholder and director of Watershed, to speak about, firstly, the unique value proposition that Watershed offers in the marketplace. Adrian.
Thank you. Thank you, first of all, for the opportunity. So, as you mentioned, we're an independently owned boutique funds management business in Melbourne, and I guess our key differentiator in the market is not just that we run multi-asset portfolios. A lot of people do that, but we run multi-asset portfolios where we manage most of the underlying components directly. So most of the Australian shares, large cap, mid cap, the international equities, and most of the fixed income ourselves. And what that means is that we can really, when we have a view, a theme that we want to implement, we can implement that right across the portfolio. And what it also enables us to do, and this is probably one of our key differentiators, is to be really dynamic in our asset allocation. So we don't just sort of tinker around the edges with the equity allocation or fixed income allocation. We can move in ranges of 20 or 30% throughout a cycle. Which is somewhat different to a lot of the multi-asset portfolios out there. So a bit of what I'll talk about today is sort of the market volatility that we've seen and that we expect, but we quite like that because our dynamic approach allows us to add value through the really volatile markets.
It's certainly the case, Adrian, and your track record since inception has been outstanding. From a multi-asset management point of view, as well as single asset management. Thank you.
Yeah. Look, I'm proud of our track record, where the business is nearly 12 or 13 years old now. And one of the keys to that, and something we focus a lot on, is being able to buy the dislocations in markets when they happen. If you go back to the GFC, we've had, two really big, almost 50% corrections, supposedly once in a lifetime events, but we've had two of them in sort of 13, 14 years. But between that, we've had two other sort of 20, 25% corrections. Three others. So you're getting one almost every 2.5 years. And if you're able to buy these dislocations in equity and credit markets along the way, you come out adding value each time. And we spend a lot of time focusing on that.
Excellent. And Adrian, is there anything in particular that keeps you awake at night right now?
Yeah, well, I'll preface it saying that I suppose I've been around for 25 years now and seen lots and lots of cycles. So, I've seen lots of corrections and lots of different market cycles. And so they don't keep me up at night. And we actually look forward to those volatile environments because it's an opportunity to really add value. But the one thing that we are thinking a lot about now is inflation. And I know that's a bit of a boring topic, and I know that it's all over the papers. But one thing that does keep me up at night a little bit, that we're spending a lot of time on, is whether we are about to enter a serious inflationary cycle. And that's something we haven't seen, the world hasn't seen really since the late 60s and early 70s. We've had a period now of 30 years where there's been, no inflation and periods of deflation, and it's almost become a view in markets that that's the new normal and that's the way it will always be. But there is a real risk, we think, with just the unbelievable amount of money that's been printed and pumped into the system over the last 18 months, that we could actually be at the start of a more prolonged inflationary period. And the last time we saw that, in the early 70s, it really created havoc for economies and it created havoc for financial markets. Yes. And that started in the late 60s, and it sort of crept. You got 3-4% inflation, but then as we hit the 70s, you had a big market correction, then a huge rebound, then another huge correction, then another huge rebound. all in the space of sort of 4 or 5 years. So that's probably the one that would keep us up at night. Even though you can add value through these cycles, they can be pretty uncomfortable as you get through them.
Yes, and certainly I guess you've spoken about the risks. Obviously, there's opportunities there as well. Are there any opportunities that come to mind?
Look, and this is going to sound sort of boring, but that in itself, I think, will be an opportunity. What I think we are seeing and have seen is that this environment since 2008, since the GFC, of central banks engaging in this quantitative easing policy, is that they have pumped so much money into the system. They've cut rates to zero. A lot of the world has negative interest rates still. And really, the end result of all of that is it distorts financial markets and it distorts asset prices. And we've seen over the last little while, there's exuberance in large pockets of the market. You look at, crypto, for example, and I'm not going to sort of comment on that, but, property prices, prices of credit, prices of artworks, all sorts of things have had phenomenal runs. But what that means in our view is that the world is creating or distorting these asset prices, which means when they correct, they will correct fairly sharply. And I think we're going to have a period of shorter, sharper cycles again. I think last year was an example of that, where we had a recession, a 40% market correction, and almost 6 months later, the global economy's growing strongly again, and markets are almost back to where they were. So if you're able to take advantage of that, I think these short, sharp cycles and movements in asset prices will actually be a great opportunity.
And if we were to look out, and I appreciate it's hard to crystal ball, but if you could look out 5 years, what do you believe you'd probably see?
Yeah, well, and I suppose these are where some of the opportunities lie as well. And I will preface it again with saying that with our process, we're really only trying to look forward 6 to 12 months. And our view is that we're trying to, there's no value in being positioned for the consensus view. So if you're positioned for what consensus is today, everybody's already there. What you need to do is be positioned for where consensus ends up in sort of 6 or 12 months' time. So that's sort of what we focus on. We don't spend a lot of time thinking about where things could be in 5 years, but I think some of the counter-cyclical sort of opportunities, and we tend to be a bit counter-cyclical, but are things like, we've seen a huge amount of money, and there will be trillions of dollars invested in sort of ESG technologies. But the flip side of that is you're seeing no investment, and there's been a decline in investment in traditional energy sources. If you look at exploration for LNG, oil and gas, you can't get financing for for coal or any of those sorts of things. Which means that as this transition happens, I think that we could be sitting here in 5 years' time with energy prices and commodity prices a lot higher than they are today, because that transition is going to take a long time to happen. And while there'll be a lot of investment in green, there won't be any investment in the brown. Which means that we could see a real commodity price spike, and not just in oil and gas and fossil fuels, but in all of the metals that are required for this energy transition. If you look at the amount of copper and lithium and nickel and cobalt and all of those sorts of things that need to go into electric cars, batteries, hydro, all of this technology is incredibly metals intensive. And I just don't think that new supply will keep up with demand over the next 5 years. So, I think we could be looking at much higher commodity prices in sort of 5 years' time. The other one that really does concern me a bit, and I didn't mention that in risks early on, is China at the moment. For the last 20 years, the global growth has almost always been underpinned by China. Whenever we've had an issue, you've seen this huge stimulus from China, and particularly here in Australia, it's been a big importer of our commodities. And so China has kind of been responsible for a lot of global growth over the last 20 years, but China now is clearly slowing down. The population's maturing, the economy is maturing. but it's also becoming a lot more insular. So I worry about the relationship between China and Australia, and I worry that it won't necessarily be the growth pillar that we've had over the last couple of major recessions. So that's one thing that I think, in 5 years' time, we probably won't have a better relationship with China than we do today, unfortunately, and that's one thing that we really need to prepare for. And this one will probably throw the cat amongst the pigeons, but another one to be concerned about potentially is if we look at the US at the moment, the politics in the US is an absolute mess. We've gone from, a chaotic presidency to, the Biden administration that's been disastrous to date. So in 5 years' time, I think we'll have a completely different government in the US, and we could be looking at another Trump government. And that would be interesting for the world to have to navigate again.
Well, Adrian, listen, I think that's a point where we should probably stop there. I think that's enough for the day.
You might want to edit that one out.
No, listen, appreciate your views this afternoon, and thanks for spending the time with us. Much obliged.
No worries, and thank you for your support.
Thank you.